Fund Supermart, your online gateway to unit trusts.
Malaysia's GDP has been moderating, with the first quarter of 2016 coming in at 4.2% year-on-year growth. Do you think Malaysia will continue to undergo a moderation in GDP growth for the coming few months? What is your outlook for Malaysia's economy for the rest of the year?
Yes, Malaysian GDP growth is definitely moderating. At the beginning of the year, Bank Negara came out with an official forecast of 4 to 4.5% for 2016 GDP growth. And we think most economists also came out with the forecast of around 4.5%. But recently, most economists have revised down their forecast to about 4.25%. The weakness in the GDP growth is attributed to weak export and also weaker private investment. But we think there is support to downside of the GDP because the government has taken measures to boost consumer disposable income. These measures include minimum wage hike, cut of 3% EPF contribution, and also civil servants pay hike. In addition, the government has also taken measures to implement more infrastructure projects, including MRT2, LRT3, and also Pembonia projects. So this will lend support to the public investment. All in, we think this year's Malaysia GDP forecast will come in at the range of 4 to 4.5% within the range of Bank Negara forecast. Bank Negara also has cut OPR rate by 25 bips recently to 3%. This will lend support to the Malaysia GDP growth.
How much further upside is there for investors, and are valuations still appealing? With FPM KLCI index continue to see earnings downgrades, what is your take on the earnings outlook?
We think at current level, KLCI at 1,660 points, there's limited upside to the market. Earnings has been disappointed for the KLCI, and from the March reporting quarter, we can see that earnings actually came in quite weak. For the March reporting quarter, 30% results were below expectation, about 60% were within, and only 9% were above expectations. The disappointment were quite broad-based, came from many sectors, including plantation, oil and gas, timber, materials, and other sectors. Only the airline sectors outperformed, while other sectors like banks and telcos were generally in line only. So we think the earnings growth for 2016 will continue to be challenging for the rest of the year.
Do you think small cap segment is a better investment opportunity at this point of time as compared to the big cap segment? Why?
Our team has always adopted a bottom-up stock picking strategy here. So that means we look at, usually for stocks, we look at earnings growth, valuation, and dividend yield on these three criteria. As long as the stocks offers a reasonable valuation, good earning growth, and attractive dividend yield, we think these stocks offer attractive investment opportunities. So regardless of the big cap or small cap, we tend to look at stocks from the quality perspective.
Where do you find investment opportunities in Malaysia, and what sectors or teams you have the most and least preference for?
Despite the challenging economic environment, we are on the continual lookout for new investment ideas. As there's limited upside to the market, as we mentioned just now, we mainly spend our time on the non-index stocks or stocks outside the market index. So regardless of the economic environment, we continue to believe there will always be companies who can deliver earnings growth. Sectors that we prefer in this sort of environment would be sectors, mainly the defensive sectors. One of them could be consumer, especially from the F&B retail, because consumers continue to spend on F&B despite a challenging economic environment. Then another sector we like will include utilities, such as the power sector, because consumers continue to use power despite difficult economic environment. Another sector that we like is also the REIT sector, because they offer 5 to 7% dividend yield, which is protect very good downside in this sort of environment. Another sector we like will include the construction sector, because there are more implementation of government projects rolling out. Sectors that we least prefer include the plantation and oil and gas sector, because due to the weak CPO price and poor oil price, we will be very selective of these sectors for exposure.
Do you think investors should opt for investments with a dividend investing strategy amid a slowing economy and increasingly volatile markets?
Firstly, back to the basic, we think investors should always select funds that are compatible with their investment objective and also risk tolerance. Generally, conservative investors and risk-averse investors tend to pick funds that focus on a dividend strategy. However, in this sort of environment where you see the market is increasingly volatile, dividend investment strategy is likely to do well relative to the market. So we think in this environment, investor should focus more on a dividend investment strategy. If Bank Negara continues to cut rate, then dividend stocks will likely to outperform the market. However, we also think investors should not disregard other stocks that could deliver good earnings growth, as they will also outperform the market.